Hello dear students, welcome to Click Education. This is accounting class. Today we are going to study chapter 3, double entry system, and we will learn how to analyze debit credit from any transaction. So let's get started. Okay. Today's contents, we will study types of accounts, types of changes in various accounts, debit credit analysis procedure, and we will summarize the total concepts of this video lesson, and finally we will solve a practice problem. Alright. Types of accounts. According to accounting equation, we know there are 5 types of accounts, and they are assets, liabilities, owner's equity, revenues, and finally expenses. So there are 5 accounts according to accounting equation, that is assets, liabilities, owner's equity, revenues, and expenses. Now we will see various changes in this accounting accounts. Okay. So types of changes in various accounts. There are various changes. Let's see. Number 1, asset account. Yeah, usually asset account is a debit account. You have to remember this. Asset account is a debit account. This debit account can be changed into 2 types. That is, either it will increase or will decrease. Either it will increase or decrease. So asset account, which is generally a debit account, increase or it will decrease. Okay. If any asset account increases, then it will debit, and if any asset account decreases, then it will credit. Okay, so note that very carefully. That is, any asset account, if increases, then we will debit it, and if any asset account decreases, then we will credit it. Okay. Let's take an example. Purchase of furniture, taka 30,000. Here I have attached the image of the previous flow diagram, so that we can recall about the changes in asset account. Okay. So let's see the solution. This is step 1. I divide the procedure into 5 different steps. So if you study these 5 steps, or remember these 5 steps, you can classify any accounts into debit credit. Okay, all right. Then see how the procedure goes on. Okay. Step 1, identify the accounts from the transaction. Okay, so according to our prescribed or given transaction, that is purchase of furniture, their related accounts are furniture account and cash account. So I have identified related accounts. We know, according to double entry system, there must be at least 2 accounts related to a transaction. So the related accounts in the transaction are furniture account and cash account. Step 2, identify the types of the accounts. Now we have to identify what type of accounts they are. Either they are asset or liabilities, or rest of the 3. Then we found furniture account is an asset account, and cash account is also an asset account. All right. Then step 3. Identify the types of changes in the accounts. Now we will identify how these accounts have changed due to the occurred transaction. Okay, Let's see, here is my flow diagram, so that we can use it when we need it. Okay, then furniture account, this is an asset account, and since we have purchased our furniture, so it increases in our business. There is a change in increase. Okay, cash account, this is also an asset account, and since we have paid cash to get the furniture, so cash decreased according to that particular transaction. So furniture account increase and asset account decrease. Now step 4, we will assign these two accounts into debit and credit. So furniture account, this is asset account, and this is increases. This increases because of our transaction, so it will be debit, and cash account, asset account, and it is decreased, so we will assign it as credit. So finally we got our result, that is furniture account debit and cash account credit. So this is the total procedures that I have divided or broken into 5 steps, so that you can follow the procedure easily to identify debit credit for any transaction. Okay. Number 2 is a liability account, and generally it is a credit account, and it also changes into either either increase or either decrease. If any liability account increases, then it will credit, and if any liability account decreases, then it will debit. So liability account, if increases, it will credit, otherwise it will debit. Okay, let's see an example. Loan taken from bank, taka 50,000. Loan taken from bank, taka 50,000. Okay, here is our flow chart for our use, and let's see the solution. Step 1, identify accounts from the transaction. According to this transaction above, the related accounts are cash account and loan account. Since we have taken a loan from the bank, so cash inflows into the business, and liability called loan was also increased due to this transaction. Okay, step 2, identify the types of the accounts. We know cash accounts account is an asset account, and loan account is a liability account. So we have done with our identification of types of accounts. Now we will go to step 3, and we'll identify the types of changes in the accounts. Since we have taken loan, so cash account, this is an asset account, has increased, and the other account, loan account, which is a liability account, has also increased because we have taken the loan. So step 4, assign debit and credit into the accounts. So since cash account as an asset account and it has increased, so it will debit, and the loan account, which is a liability account, due to increase in liability, it will also credit. Okay, so finally we get our result, that is cash account debit, loan account credit. Now you can check pausing the video from the image that I have attached into this page, so that you can easily use this If you have any confusion, you can check back from this diagram and can learn very carefully. All right. Now number 3, this is owner security account, and usually it is a credit account, and it either increase or decrease. Owner security account, which is a credit account, it will either increase or decrease. Okay, if owner security account increases, then it will credit, otherwise it will debit. If increases, it will credit, otherwise it will debit. So here is our example. The owner started his business with taka 1 lakh. The owner started his business with taka 1 lakh. So here is our diagram and here is our solution. From now I'm not going to break down all the steps to identify debit credit. I will do this time directly. So there is no mention of steps, just the procedure is described here. So according to transaction cash account, since owner started the business with taka 1 lakh, that means cash inflows into the business, and the ownership they are created ownership of the owner. So cash account, which is an asset account, and it is increased due to the investment of the owner, and from our theory, increase in asset account, it will debit, and the other account is capital account. Since the owner invested taka 1 lakh as a capital, so the other account is capital, and capital account is a liability account, and it is also increased, and that's why we will credit it. So capital account, which is a liability account, due to increase in liability, we will assign it as credit. All right. So finally we got our result, that is cash account debit and capital account credit. Cash account debit, capital account credit. So far we have done with 3 changes in accounts. Now we will see the 4th one. So 4th one is revenue account, and usually it is a credit account. So revenue account is a credit account. It also can changes into either increase or decrease. So if any credit account, revenue account increases, then it will credit, and if any revenue account decreases, then we will debit it. So from the flow diagram we can see any revenue account, if increases, we will credit it, otherwise we will debit it. Okay. Now from our example, goods sold taka 15,000. Goods sold taka 15,000. Here is our diagram and solution. So since we have sold goods taka 15,000, so received taka cash, so cash account, which is an asset account, it has increased due to sale of goods, and thereby we will debit it, because any increase in asset we will debit it. For any increase in asset we will debit it. And the other account is sales account, and sales account is a revenue account. Sales account is a revenue account. So sales account, revenue account, it has also increased because we made sales of goods for taka 15,000. So it revenue accounts also increases, and we know from our diagram that when any revenue account increases, we credit it. So finally we get our result: cash account debit, sales account credit. cash account debit, sales account credit, cash account debit, sales account credit. Okay, now number 5, expense account, the final one. Usually it is a debit account. Expense account generally a debit account. So if debit account or expense account increases, we will debit it. If any expense account increases, we will debit it, otherwise we will credit it. So listen very carefully and remember it. Any expense account when increases, we will debit it, and if any expense account decreases, we will credit it. So here is our example. Goods purchased taka 15,000, goods purchased taka 15,000. This is just opposite of the example 4, and the solution is the related account is purchase account, since goods are purchased for taka 15,000. so purchase account, this is an expense account, and it has increased for the transaction, and because of increase we will debit it. Because of increase in expense account, we will debit purchase account. Okay, then the other account is cash account, because we have paid the cash for purchased goods. So cash account, which is an asset account, and this has decreased. This has decreased because we made payment by cash. So due to decrease in cash or asset account, we will credit it. So finally our result is purchase account debit, cash account credit, purchase account debit, cash account credit. So these all are 5 changes in various changes in 5 accounts. Now we will summarize the total concept that learned in this video. There are 5 accounts, you already know. There are assets, liabilities, owner's equity, revenues, expenses. Okay, two of these 5 accounts are debit. So let's see them. Assets and expenses are 2 accounts that are always debit, that are always debit account, and either it will increase or decrease. If those accounts increase, then they will be debited, otherwise they will be credited. If these 2 accounts increase, then we will debit them, or if they decrease, we will credit them. Okay, the other 3 which are liabilities, owner's equity, and revenues account are credit account. You have to remember this. Note very carefully that assets and expenses are debit, liabilities, owner's equity, and revenues are credit account. Okay, these accounts increase, then we will credit them, or if they decrease, we will debit them. So for these 3 accounts, that are liabilities, owner's equity, and revenues, since they all are credit account, if they increase, we will credit them, and otherwise we will debit them. Okay, now we will solve a real practice problem. So we will meet there. Okay.